Most traders surrender their capital before the real move even begins, not from bad luck, but from stepping in front of the composite operator's design. The moment you chase price, you become the liquidity professionals are selling into. Rule No.1. Never commit until the market itself confirms intent. Let the tape speak before your capital moves. That single discipline has preserved more fortunes than every indicator, every signal, and every analyst on Wall Street combined. In early 2020, crude oil showed a classic distribution phase. Volume swelled at the highs while price barely advanced. The untrained eye saw strength. Wyckoff's eye saw the composite operator unloading. Traders who waited for a confirmed sign of weakness before acting short protected capital. Those who bought the breakout, they funded the professional's exit. Every year, thousands of traders enter the market with capital, conviction, and careful preparation, and still they are systematically stripped of everything, not by misfortune, not by complexity, but by a force they never once stopped to identify. They study charts for hours, consume every piece of financial news, watch every candlestick form in real time, and yet they remain blind to the single entity that determines where price will go before it goes there. That blindness is not accidental, it is manufactured. You must resist the urge to act on what the market shows you on the surface. The headline that screams bullish momentum, the breakout that looks undeniable, the volume spike that feels like confirmation. These are not signals meant for your benefit. They are invitations, carefully constructed by those who operate at a scale most retail participants cannot fathom, designed to pull your capital into positions that serve their exit, not your entry. In today's markets, this composite operator does not wear a single face. It is the institutional desk quietly accumulating shares across dark pools before a single analyst upgrades the stock. It is the algorithmic engine absorbing sell orders during a manufactured dip in the S&P 500 futures at 3 a.m. when liquidity is thin and retail stops are clustered just below support. It is the hedge fund distributing positions into the euphoric retail buying that follows a strong earnings beat. The names change. The instruments change. The mechanism never. Understand this principle with absolute clarity. The composite operator does not react to the market, it engineers the market. Every shakeout, every false breakout, every sudden reversal that stops you out before the real move begins, these are not accidents of volatility. They are deliberate operations executed with one purpose: to transfer ownership of an asset from uninformed hands into informed ones, or vice versa, at the most advantageous price possible. In modern trading, this manifests precisely in the behavior of large cap equities before earnings, in cryptocurrency markets during weekend low liquidity sessions, in Forex pairs during news events where price spikes violently in one direction only to reverse and move with conviction the other way. Study these moments not with frustration, but with the eye of a detective. Ask always who benefited from that move, whose stops were collected, whose liquidity was consumed. When you begin to see the market through this lens, something profound shifts in your trading. You stop being the prey. You stop reacting to engineered fear and manufactured excitement. You begin to read the tape the way it was meant to be read, as a record of professional intention, not random noise. The composite operator cannot hide forever. Its footprints are always visible in the relationship between price and volume. Your singular advantage is knowing where to look. Richard D. Wyckoff says, "The tape tells the truth if you have the patience to listen and the discipline not to act before it speaks." There is a moment every trader knows, the moment you stare at your screen, watching price climb with conviction, every indicator aligned, every signal confirming the narrative perfect, and you commit your capital. Then, without warning, the move dies, price reverses, the position bleeds, and you are left asking the same haunting question that has destroyed more trading accounts than any market crash in history. What did I miss? You missed the one thing that never lies. Before you place another trade, before you trust another breakout, another trend line, another pattern that looks textbook perfect, you must learn to pause and interrogate the market with a single, non-negotiable question. Not, where is price going? But, is the effort behind this move justified by its result? That pause, that moment of disciplined restraint, is what separates the professional from the perpetual loser. In today's markets, traders are drowning in data. RSI, MACD, Bollinger Bands, moving average crossovers, AI-generated signals, an entire industry built around the illusion that complexity produces edge. Meanwhile, the most powerful tool available sits quietly on every single chart, ignored by the majority, misread by most. It requires no subscription, no algorithm, no special platform. It has been available since the first ticker tape rolled off the machine in 1867. It is volume. Here is the truth that Wyckoff discovered, and that modern markets confirm every single day. Without exception, price and volume must agree, or the move cannot be trusted. When price advances significantly on expanding volume, genuine demand is present. Informed money is committing. The move has substance. But when price surges dramatically while volume remains thin and unconvincing, there is no real buying behind that advance. It is a hollow move, a theatrical performance staged to attract retail participation into a position that professionals are quietly preparing to abandon. The reverse is equally powerful and equally ignored. When price declines sharply on massive volume, yet closes near the high of the bar, supply has been absorbed. The selling climax has occurred. The composite operator has used that fear-driven capitulation to accumulate inventory at wholesale prices. In 2022, Bitcoin demonstrated this exact behavior at its cycle low. In 2020, every major equity index printed identical signatures at the March bottom. The tape broadcast the truth clearly. Most traders, consumed by narrative and emotion, never looked. Apply this discipline in your modern trading with ruthless consistency. Before every entry, examine the volume behind the move that created your setup. A breakout above resistance on 3 times average volume is a message. The same breakout on half average volume is a trap. A support bounce accompanied by a volume surge, and a closing price at the candle's high is absorption. Without that volume confirmation, it is noise. Strip away every indicator. Remove every overlay. When you finally learn to read price and volume together as one unified language, the market stops feeling chaotic. It begins to feel like a conversation you can finally understand. Richard D. Wyckoff said, "Volume is the energy behind price. Without it, movement is merely illusion dressed as opportunity." There is a specific kind of pain that no trading book prepares you for, the pain of watching a stock, a currency pair, a cryptocurrency move sideways for weeks, sometimes months, while you sit on the outside questioning your read, your patience, your entire methodology. Then, the moment your conviction breaks and you step away, the instrument explodes upward without you. So the next time, you enter early. You buy into the range. You tell yourself this time you will be positioned before the move. And the market, as if it knows precisely what you have done, drops sharply below your entry, triggers your stop, takes your capital, and then launches into the very move you anticipated all along. This is not misfortune. This is the system working exactly as designed against you. Every instinct you have developed as a human being, the impatience, the fear of missing the move, the desperate need to be inside the trade before it begins. Every one of those instincts is a liability in the financial markets. The composite operator understands retail psychology with surgical precision. It knows that traders cannot endure prolonged stillness. It knows that a long, grinding sideways range produces anxiety, boredom, and eventually reckless action. And it exploits that predictability with a maneuver so consistent, so repeatable across every market and every time frame, that Wyckoff identified it over a century ago, and it remains equally devastating today. That maneuver is the spring. Understand what is truly happening during an accumulation phase. Price is not moving sideways randomly. The composite operator is methodically absorbing available supply, purchasing every share, every contract, every unit of the asset that uninformed sellers are willing to surrender. This process requires time, and it requires one final, critical operation before the markup phase can begin. It requires the elimination of every weak hand still holding a position inside that range. The spring is that elimination. Price is deliberately driven below the established support level, the level where every retail trader who studied the chart has placed their stop loss. The stops are triggered. The weak hands are expelled. Panic selling floods the market, and the composite operator absorbs every single unit of that panic at the lowest possible price. Then, just as swiftly and without ceremony, price reclaims the range and the markup begins. In modern markets, this signature appears with remarkable consistency. In 2023, Tesla printed a textbook spring below its long-term accumulation base before a 60% advance. Bitcoin's entire 2020 accumulation structure resolved through a precise spring below the March low before its historic bull run. Forex traders witness this daily in the London open session, a sharp spike below Asian session lows that collect stops before the real directional move emerges. Your singular instruction is this: map the range, identify the support, mark the level where stops will cluster, and do nothing until price tests that level, rejects it with conviction, and reclaims the range on expanding volume. That one act of disciplined restraint removes you from the category of liquidity being harvested and places you, finally, alongside the professionals harvesting it. Richard D. Wyckoff said that the spring is not a threat to your position, it is the market's final invitation to those patient enough to read its language. There is a trade that every serious trader has taken and regretted with a particular lasting bitterness. The setup looked legitimate. The pattern was recognizable. The entry was clean. You sized the position with confidence because everything on the chart told you this was real. Then the move came, small, unconvincing, barely enough to cover your spread, and reversed entirely, erasing whatever modest profit existed, and eventually stopping you out at a loss. The pattern was correct, the direction was correct, and yet the trade destroyed capital. The reason lies in a law most traders never discover, and the ones who do discover it far too late. Before committing a single unit of capital to any trade, before trusting any pattern, regardless of how technically perfect it appears, you must interrogate one dimension of the chart that most modern traders skip entirely. Not the entry trigger, not the risk-reward ratio, not the confluence of time frames. You must examine with absolute seriousness the size and duration of the base that preceded the move you intend to trade. That examination alone will save you from an entire category of losses that no stop loss, no position sizing formula, and no risk management system can protect you from, because a stop loss manages the loss after it begins. This law prevents you from entering the losing trade in the first place. Wyckoff's law of cause and effect is not a metaphor, it is a market principle as mechanical and reliable as physics. The cause is the accumulation or distribution phase. The effect is the subsequent trend, and the relationship between the two is non-negotiable. A small cause can only produce a small effect. A shallow, narrow, brief trading range does not contain enough absorbed supply or distributed inventory to fuel a significant directional move. The composite operator has not committed sufficient force. The campaign is too small. The ammunition is insufficient. In modern markets, this law manifests with brutal clarity. A cryptocurrency that consolidates for 11 days before breaking out cannot sustain a move equivalent to one that consolidated for 11 weeks. An equity printing a tight 3-week base after a minor pullback cannot deliver the same effect as one building a 6-month accumulation structure following a deep markdown. Traders who ignore this distinction chase every clean, looking breakout regardless of the cause beneath it, and they fund their losses with mechanical regularity. Apply this principle with a concrete modern framework. Before any trade, measure the width of the base using point and figure methodology, or simply count the time spent in consolidation. Estimate the projected move that cause can realistically produce. Then compare that projection against your target. If the cause cannot mathematically justify the effect you require for the trade to be worthwhile, you do not take the trade. Not because the setup is wrong, because the fuel is insufficient for the journey. When this discipline becomes instinctive, something transformative happens to your trading. You stop entering setups that were always destined to disappoint. You stop blaming execution when the real failure was selection. You begin to reserve your capital exclusively for campaigns where the cause is so substantial, so undeniable in its construction, that the effect almost cannot fail to deliver. The market rewards patience applied with precision. Build the habit of measuring before you move, and the market's largest, most powerful trends will begin to feel like they were built specifically for your account. Never mistake a small cause for a large opportunity. The market always settles its debts exactly as the foundation demands, never more. There is a particular breed of trader, intelligent, analytical, deeply studied, who loses money not because they lack knowledge, but because they are permanently at war with the market. They short the strongest stocks in a raging bull trend because valuations look stretched. They buy aggressively into collapsing assets because the price looks historically cheap. They fight every move that offends their logic, their economic understanding, their fundamental conviction, and the market, with absolute indifference to their intelligence and their reasoning, destroys their capital with the same mechanical efficiency it applies to the most reckless, uninformed speculator on the exchange. Brilliance, without alignment, is simply an expensive opinion. Every time you feel the powerful urge to position yourself against a dominant trend, stop. Not because contrarian thinking is always wrong, but because the market does not reward correctness of analysis. It rewards alignment with the dominant force currently in control. That distinction is everything. You can construct the most intellectually sound bearish thesis on a rising market and still lose every dollar you commit to that thesis because price moves on the behavior of the composite operator, not on the accuracy of your reasoning. The modern trading environment amplifies this danger exponentially. Social media fills your screen with analysts calling tops in bull markets and bottoms in bear markets, each argument more compelling than the last, each supported by data, history, and sophisticated logic. Retail traders consume this content, become convinced, and position accordingly. Then the trend, indifferent, mechanical, institutional, continues in its original direction, harvesting every premature counter, trend position with ruthless consistency. Wyckoff understood a principle that cuts through all complexity with elegant simplicity. Price always moves along the path of least resistance, and that path is determined exclusively by the balance between supply and demand at any given moment. When demand dominates, the path of least resistance is upward. Overhead supply has been absorbed, sellers are exhausted, and every attempt to push price lower is met with immediate, aggressive buying. Fighting that condition is not trading, it is destruction of capital disguised as conviction. When supply dominates, when every rally is met with selling pressure, when volume expands on down days and contracts on up days, when the market cannot hold any advance, the path of least resistance is downward. No amount of fundamental cheapness, no historical valuation metric, no analyst price target changes that physical reality until the supply itself is exhausted. In modern application, this principle demands one non-negotiable habit: determine the dominant trend on the higher time frame before executing on any lower time frame signal. A long setup on a daily chart means nothing if the weekly structure is in a confirmed downtrend. A short signal on a 15-minute chart is fighting institutional buying if the daily trend is in a healthy markup phase. In 2023, traders who shorted Nvidia based on valuation concerns while its weekly structure printed relentless higher highs paid an enormous price for that misalignment. Read the market across time frames. Identify where the composite operator is genuinely committed, then position in that direction exclusively, and hold with the confidence of someone who finally understands that the market's dominant force is not your enemy. It is, when properly aligned, the most powerful ally your capital has ever had. The successful trader does not impose direction upon the market. He discovers the direction the market has already chosen and simply follows. There is a moment that haunts every trader who has experienced it. The moment you watch a massive volume bar print on your chart, larger than anything seen in weeks, and every instinct in your body screams conviction. The market is moving. Something significant is happening. A catalyst has arrived. You feel the pull of certainty, that seductive, dangerous sensation that this volume means direction, that this effort means the move is real, that committing your capital right now is not impulsive but inevitable. So you enter. And then, with a cruelty that feels almost personal, price goes nowhere. Or worse, it reverses directly into your position with the same force that attracted you in the first place. The volume was real, the move was not, and your capital paid for the confusion between the two. Before you ever again allow a large volume bar to seduce you into a trade, before you interpret any surge in market activity as automatic confirmation of direction, you must develop the discipline to ask one question that most traders never think to ask. Not, how much volume is present, but what did all of that volume actually produce? That single shift in questioning will protect you from an entire category of professional deception that operates openly on every chart, in every market, on every time frame, visible to anyone trained to see it, invisible and lethal to everyone who is not. In today's high-frequency, algorithmically dominated markets, this deception has become more sophisticated and more frequent than at any point in trading history. Dark pool activity, iceberg orders, and institutional accumulation and distribution operations are specifically engineered to create misleading volume signatures. A hedge fund distributing millions of shares into a retail-driven rally will generate enormous volume, but price will struggle to advance because every attempt upward is met with fresh supply being unloaded. The effort is massive. The result is absent, and that absence is the confession. This is the principle Wyckoff identified as the most revealing diagnostic in all of tape reading. Effort and result must be proportional, and any significant divergence between the two exposes professional intention that price alone will never reveal. When colossal effort produces no meaningful result, the market is lying to you about its direction. When modest effort produces a disproportionately large result, the path of least resistance has just revealed itself with unmistakable clarity. The practical applications in modern trading are immediate and specific. When an equity gaps up on an earnings beat, prints a massive volume bar, and closes flat or negative, distribution is occurring into retail euphoria. Exit or avoid. When Bitcoin prints a high volume down bar that closes in the upper half of its range during a supposed breakdown, absorption is occurring. The markdown is exhausted. When a Forex pair spikes violently on a news event, generates extraordinary volume, and then reverses to close near its open, the stop hunt is complete, and the real institutional move is about to begin in the opposite direction. Train your eye to measure every significant volume event against its corresponding price result with the precision of a scientist evaluating data. Build the habit of asking, on every meaningful bar, did the market's effort justify its outcome? When the answer is no, Step aside with absolute conviction, regardless of how compelling the narrative surrounding that move appears. When this diagnostic becomes second nature, the market's most dangerous illusions lose their power over you entirely. The manipulated breakout no longer looks like opportunity. The distribution rally no longer feels like strength. The engineered sell-off no longer triggers panic, it triggers recognition. You stop being the trader who funds professional operations. You become the trader who reads them, respects them, and positions accordingly. The market's greatest deceptions are always conducted in plain sight. Effort without result is the confession professionals never intend for you to hear, but leave on every chart regardless. Look honestly at the trader you were before these 6 principles entered your understanding. That trader woke up every morning and walked into the most sophisticated wealth transfer mechanism ever constructed, armed with indicators, opinions, and emotions, competing against institutions with unlimited capital, algorithmic precision, and a century of refined methodology designed specifically to separate retail participants from their money. That trader did not lose because the market was unfair. That trader lost because the market was perfectly, ruthlessly fair, and simply rewarded those who understood its true language over those who only heard its noise. That realization, sitting with its full weight, should disturb you. But before you dismiss everything you thought you knew and rebuild from nothing, understand that the principles laid before you today do not require you to become a different person. They do not demand a new platform, a new strategy, or a new instrument. They demand only one transformation, a transformation of perception. The same charts you have studied for months or years contain every answer these keynotes describe. The composite operator's footprints are already there. The volume confessions are already printed. The springs have already formed and will form again. The causes are already building their effects in real time on markets you watch every single day. You were simply never shown where to look. So here is what these 6 keynotes, taken together, have given you. They have given you the ability to identify the invisible force engineering every major market move before it completes, and position with it rather than against it. They have given you the only diagnostic tool that never fabricates signals, the relationship between price and volume, and the discipline to trust it over every indicator, every analyst, and every compelling narrative the financial media constructs. They have given you the patience to survive the accumulation phase without surrendering your position to a spring designed to expel you. They have given you the judgment to measure every cause before committing capital to its effect, ensuring you only enter campaigns where the fuel matches the journey. They have given you the clarity to identify the dominant path of least resistance and the discipline to trade exclusively in its direction, regardless of what your opinion, your ego, or the crowd demands. And finally, they have given you the single most powerful lie detector in all of trading, the ability to recognize when enormous effort produces no meaningful result, and to step aside before that deception costs you everything. These are not 6 separate rules. They are one unified methodology, a complete lens through which the market finally becomes readable, predictable in its structure, and navigable with genuine confidence. Wyckoff did not construct this method in a classroom. He constructed it on the floor of the most brutal financial environment of his era, watching fortunes built and destroyed in real time, extracting from that chaos the permanent principles that no market condition, no technological evolution, and no algorithmic advancement has ever been able to invalidate, because human nature has not changed. Institutional behavior has not changed. The composite operator still engineers. Supply and demand still govern. Effort still confesses when result fails to follow. The market has always been a conversation between the informed and the uninformed. For the first time, you now speak the language. The game has never changed, Only the players who understand it have ever truly profited from it. Now you understand it. The rest is simply the discipline to act on what you know,